Good morning, everybody, and welcome to my live weekly market update where I talk about all things that are happening this week in mortgage, in real estate. So let's dive right in and talk about what's going on this week. It has been a bad week for interest rates. We've seen rates move up this week for a couple of reasons. The biggest one, though, being inflation. A lot of things have impacted interest rates this week. And I want to go over that. And really what I want to talk about as a big theme is when the heck are we going to see mortgage rates come down? Because everybody was talking about rates coming down. I was talking about rates coming down. I still feel like it's going to happen. But I've said over and over again, it's not a straight line down. We're going to see a lot of volatility on the way down because we're changing our thinking. It's kind of funny. Everybody said back in December, the Fed pivoted. The Fed changed their mindset. Well, they changed the things they were saying, but they didn't change their actions. And it's no different than your kids when they're doing something wrong and they say, okay, mom and dad, I understand. I'm going to stop doing that. But their actions don't change. And the Fed has actually taken no steps to do anything different. They're just saying things that are different. And ultimately, they need to project their changes early so the market doesn't think they're being fickle. If you think the Fed's being fickle, you're not going to trust them. And that's one of the biggest concerns. But it's really creating concern about nobody really knows what the Fed's going to do because they're leaving too much ambiguity. And they're saying very clearly, hey, we only care about inflation coming down and we're worried about that. And now that inflation is down, they're saying, well, no, we're not worried about other things and that we're not so worried about inflation coming down only. So now we're worried about the jobs reports and jobs going up. And now this week, retail sales created an issue. And so let's give a quick breakdown of how this works and what all this means. So I'm going to share my screen with you, and I'm going to show you what most people see in the news. Every single Thursday, they publish a mortgage rate number that comes from Freddie Mac. And so right here it says, as of yesterday, let me zoom in a little bit for you here. And it says that the average interest rate as of yesterday was 6.77%. The problem is that wasn't yesterday's interest rate. That was what they published yesterday. And if we look at the chart right here, this goes back all the way back to March, but this is more of a live tracker of interest rates. And it shows way down at the bottom of the screen, there's a date there. And you got to trust me, it was at 6.64 on February 1st, which was about the lowest we had seen. And these are averages of interest rates. And then we popped up to over 7% on February 5th. And on February 12th, that was Monday, we were at 6.96%. And then Tuesday happened. And Tuesday, the 13th, we saw interest rates jump from overnight from 6.96 to 7.13 on average. The problem is this market survey from Freddie Mac is sent out on Fridays. So they sent it out last Friday to mortgage lenders. And then the lenders turn them in on Monday or Tuesday. And so on Monday, interest rates were lower, and that's what they submitted, and that's what Freddie Mac is publishing. So when you say, hey, where are rates going? You look at the numbers, it doesn't actually tell the accurate picture. And so the numbers change. But the other thing about it is points. What you pay in points. Points are a percent of your loan amount that you pay as a fee. Make me a little bigger. So points are a percentage of your loan amount you pay as a fee. And Freddie Mac came out with a survey not their survey. Basically, Freddie Mac does a monthly update. And in January, they talked specifically about points that people are paying and that it's a bad idea. And I had 3 clients in the last month that have said, John, I was told by somebody that it's a bad idea to pay points when interest rates are coming down. That they are correct. It is a bad idea to pay points when interest rates are coming down. Then why is everybody paying points? Because Freddie Mac's survey very clearly says that interest rates, here we go. We found that a share of borrowers who paid discount points increased in 2023. 58.8% of purchase mortgage borrowers paid discount points in 2023 compared to 31% in 2021 and 53% in 2022. So why are people paying more in points as rates are going higher? There's a couple of reasons for that. One is that Fannie Mae has always required points as part of risk. The difference is we used to be able to easily include that in the interest rate. So let me give you an example. If you would think, hey, I've got a 720 credit score and I'm putting 20% down. That makes me a super attractive buyer, right? Wrong. When you're putting a 20% down payment, you fall into this category right here. I'm going to zoom in a little bit here to make it easier for you to see. And so this is a chart that Fannie Mae puts out, and it says, okay, so you're right here, 700 credit score, and I'm loaning you 80% of the value of your home. Fannie Mae says I have to charge you 1.375% or 1 3/8 points as a fee to get that interest rate. The same interest rate that someone with a 780 FICO score putting 25% down would pay 0 points for. And so the challenge is we used to be able to say, hey, to pay for those points, we'll just bump your interest rate by 1/4 or 0.5%, and you don't have to worry about paying those points. But the market won't absorb the points as easily. As rates are starting to come, as rates are high, the market fully understands that those interest rates are not going to stay high. And so for the same reason that it's a bad idea for you to pay the points, it's a bad idea for a lender to pay them on your behalf. Let me be really, really clear here. These fees that we are seeing right here, that we as lenders are required to charge, somebody's got to pay for them. If you're not paying for it, it's the lender that is. And so the lender says, okay, I'm going to bump your interest rate from 7% to 7.5%, and I'm going to cover 1.5% of your loan amount for fees. Okay, well, that means that it takes a 3-year break-even point. But you would say, John, as a borrower, I know I'm not going to keep this loan for 3 years. So I'd rather pay the 0.5% higher in interest rates because I'm only paying maybe 2 years on this loan, which means it only costs me 1% more in overall interest, which is cheaper than the 1.5% that you would have to pay up front. But the lender knows that too. And the lender says, you're not going to keep this loan for 3 years. I'm never going to recover that cost. I'm never going to make up for the money that I spent up front. And so we're not willing to cover those points for you, even though you shouldn't want to pay them. We aren't going to pay them. I don't mean we like my company, but the mortgage world, the bond market, the mortgage-backed securities market, the banks aren't dumb. They're thinking the same thing that you are. And so that article that Freddie Mac came out and said, hey, people are paying discount points. So declining affordability leads borrowers to pay more in discount points to buy down an interest rate. But our research suggests it's not worth it. It isn't worth it. If rates are at 7 and you say, hey, I want to pay extra to get a rate at 6.5. Well, that's not a good idea because the truth is rates at some point in the next couple of years are going to fall below 6.5. Why pay a fee now to get a lower interest rate on a loan you're not going to keep very long? It's not a good idea to do a permanent buy down. But oftentimes these points that you're paying aren't to give you a lower interest rate. The points that you are paying are to pay for the risk associated with your loan. So John, that's great, but you're telling us when are we going to see interest rates come down? So let me explain that a little more clearly. The Fed does not control mortgage rates, but the Fed controls how the economy moves, and they're pulling levers and pulling the strings of the economy. And the inflation report this week came out on Tuesday was higher than expected. And that coupled with the fact that the payroll report, in other words, there's a report the first Friday of every month that says how many jobs were created. The first Friday in February showed a huge increase in jobs. I told you this last week. More jobs means people have more income. When you have more income, you have more money to spend. If you have more money to spend, then prices of goods and services go up, and that's the definition of inflation. So the Federal Reserve said the last Wednesday in January, we think we're going to lower interest rates, but we're going to keep an eye on employment, because if employment starts going stronger, we're probably not going to lower rates. And we're going to keep an eye on inflation, because if inflation stays up and doesn't continue declining, we're probably not going to lower rates. Both of those things came true this month. We had employment that looked really strong, and we had an inflation report on Tuesday that was high. Now, there was a report yesterday that was the amount of retail sales and how much money retail salespeople made in sales last month. And that report shows that sales are down, which is a really good indication that the economy is headed for some trouble. But So that's good news for the argument that we should be lowering interest rates to keep the economy from getting too deep into a recession. But that's not the most important thing the Fed's looking at. So that helped rates a little bit yesterday. Today, another inflation report came out, and it showed inflation high as well. So 2 inflation reports back to back and a jobs report in February, all are bad news for mortgage rates. I see rates staying high for the next couple of weeks to the next month. Why? Because we have to see next month's confirmation of those same reports. We have to see, what does the jobs report look like the first Friday in March? What do the inflation reports look like in mid-March? Hopefully, those numbers will look better, meaning not as many jobs created. I think the report that came out the beginning of February was an anomaly, and we're not going to see that as a regular trend, and we'll know more next month when it comes out. So when are we going to see interest rates drop? I don't know. I know that the trend is clearly moving down, but we've seen a lot of volatility, and we're going to continue to see a lot of volatility. So let's talk about my next topic. My next topic is, do you feel stuck in the home you purchased in the last few years? Now, why do I want to talk about this? For a couple of reasons. First of all, it's why house prices are remaining high, because a lot of people aren't selling their home, even though they want to. You might be one of these people that feels like, I don't really love this house. I bought it in 2021 when the market was crazy and I didn't have any choice of houses, and I just needed to get something, and I settled and I'm not happy. But what you have is a super low interest rate. And what you have is a good amount of equity in your home, but you don't want to sell your home and be homeless and then turn around and not have a home to buy because the market is competitive. And so I have what's called a bridge loan. And it's a really, really good bridge loan that basically lets you buy a home. You can take the equity from your current home. You can buy your next home using that equity. You will not make a payment for 6 months on the house you just moved out of, while it gives you 6 months to sell the home. If you don't sell the home in 6 months, then the bridge loan program will buy the home from you at a preset price. Now, you're not going to like that price, but you have 6 months to sell the house for anything above that price. And if it doesn't sell, then you're happy that you have someone who can buy it from you for sure. So you will never have to worry about having 2 house payments, and you can get the equity from your current home to buy your next house first before you sell the current house. So if you're in that situation, I have a really good solution for you. Reach out to me and I can send you the information on it. I have a video on it and some real detailed information on how it's going to work. The last thing I want to talk about really quickly, strategies to tap into your home equity. So if you are a current homeowner, a lot of people, like I just talked about, have really good interest rates on their home, but they also have a lot of debt. We really, as a society, have increased our debt significantly over the last couple of years. And I'm seeing people with huge amounts of credit card debt, and they're in trouble. And you've got a nest egg of the equity in your home, but you don't want to get rid of that low interest rate. There's some great options right now. And a lot of people, local banks offer some really good options if you're looking for a small loan amount and you can prove your income. I say small, they're good for loan amounts up to $75,000 to $100,000. And I know some great community banks that do a really good job with that because they're loaning their own money. They can do it with relatively cheap fees, but you're looking at interest rates on these loans are in the 8.5 is a great rate on a home equity loan. And you're probably looking at more like 9 or 10%, but that's way cheaper than what you're paying on your credit cards right now. And your credit cards are not tax deductible. The problem is a lot of people don't qualify for what the bank is offering. Either they don't have enough equity in their home, because banks often will stop you at borrowing 70% of the value in total between your current first and your new second mortgage. Or you don't meet their credit criteria, or more importantly, you can't prove enough income. If those situations sound like you, I have some great options to help you out with that as well, because we have the ability to loan you up to 90% of the value of your home. So we can tap into a much greater percentage. Now, it's going to cost more in interest, but even if it's an 11 or 12% interest rate, that's still cheaper than what you're paying in your credit cards. And if you're in a situation where you can't prove your income, maybe you're self-employed and you don't show a lot of profit on your tax returns, we can use bank statements to prove your income to get these home equity loans. And the nice thing is you can use the money for anything you want. You can use it to pull cash out on your property in order to do home improvements, to pay off credit card debt. As I mentioned, a lot of people don't love the house they're in, but if you don't have the ability to move, then make that house better. Improve the house, add on that room, add that bathroom, do some remodeling. Now is the time. Now you're going to say, John, rates are high. What do you mean now is the time? Look, you're stuck in the house no matter what. You've got a super low interest rate. If you move, you're going to lose that interest rate. So you're better off just taking a chunk of money at a higher interest rate, because it's about lifestyle. It's about enjoying the life that we're in. And I'm not saying be stupid about your money to enjoy your lifestyle, but please don't be one of those people that makes the house they love the day before they move out. Too many people I see make the house they love the day before they move out, because they had all of these plans to live in this amazing house and have this garden and have this gazebo, and they never did it. And they waited and they waited and they waited. And they never got to enjoy it until they're ready to sell the house. And the realtor says, hey, you got to clean it up and make it look better. If you put in 10 grand, it'll be worth 20 grand more. And so you do. And you turn it into the house of your dreams that you give to somebody else. Don't be that person. Don't just accept things as good enough. I actually heard a story this morning. I'll end with this, but it was actually very profound as I thought about it. The amount of pain that we're in drives how hard we work to make change. As an example, if I said to you, hey, if you wanted to travel less than 1 mile from your home, then you have to walk. If you're traveling more than 1 mile from your home, then you get to drive. Then it actually is easier to go somewhere that is 1.5 miles away than it is to go somewhere that's 3/4 of a mile away. Why? Because, well, the short distance I told you have to walk. So it actually is harder to go that short distance. Now, what does that mean to the bigger picture of what I'm saying about pain? Imagine you are in a job that you don't really love. It's not really that, it's not the best job. It's not the worst job. The pain isn't that high. And so you're saying, well, the risks are pretty big. If I leave this job and go somewhere else, I don't know what it's going to be on the other side. And so you make no change, okay? Because the pain of making a change is greater than the pain that you're feeling. But when the pain becomes greater, when you have a bigger amount of pain, if the job is horrible and you hate going to work every single day and the pain is huge, you're going to make the change even though you have the same risks on the other side. Think about this in relation to the house that you're in. And you say, you know what? I'm happy enough with the house. I don't want to necessarily do any improvements on it. Okay, so you've got the pain of spending some money. You've got the pain of dealing with contractors and doing the improvements, compared with the benefit of, I'm going to make it a little bit better. So you don't do the work, but then it's time to sell the house. And then you say, okay, well, I got the pain of finding the money. I got the pain of dealing with contractors and dealing with work being done. But the benefit is I make twice as much money on the sale of my house. So I'm going to do it. I'm going to do it. And so you actually take action because the pain is greater. You're saying, I'm not going to miss out on this growth in my equity and the growth on how much I can sell my home for. And so let me summarize this by simply saying, take action before the pain gets so big, because you're going to take action anyway at some point in time. But we postpone, we procrastinate. We think that we're doing the right thing when the truth is we're just postponing the decision and postponing the good things that come on the other side of tough decisions. All good things in life live on the other side of a tough decision. And the truth is, if you think back, most of the good things that you have in your life, you had to make a tough decision. Should I get married? Should I buy the house? Should I take on that job? All of those things required a tough decision. But most of the time, your gut told you it was the right decision. So think about that when you're thinking about making a move, when you're thinking about buying a home. You may be comfortable where you're at, but the truth is it's holding you back from making a decision that's going to help you get your goals completed faster. So don't hold back by allowing complacency and comfort be holding you back. Guys, thank you so much for listening. I really appreciate it. Please, if there's anything I can do for you, I would love the opportunity to serve you, and hope you all have a wonderful holiday weekend. We'll talk to you soon. Bye-bye.